the idea of retiring early can be really exciting for a lot of us, but it's also important we make the right decision for ourselves. So in today's video, I'm going to share with you the 5 most common mistakes that people make when they decide to retire early. And the number one mistake, in fact, I just talked to somebody 2 nights ago about this, is underestimating their expenses in retirement, both today and also in 10 years, in 20 years, and in 30 years. You know, it's easy to say, okay, well, my expenses are at this level now, and if I retired, I could bring those down. And particularly if you retired in a foreign country that has a lower cost of living, you can even imagine it being lower than that. But it's super important that we have a pretty accurate forecast on what our expenses are going to be, what our reality is going to look like based on the type of retirement that we want. The gentleman that I mentioned that I just talked to 2 nights ago, he actually retired in Guatemala in his 40s, but he dramatically underestimated how much money he was going to need, and now he's in his mid-50s, and he's run out of money, and he's had to go back to work, and that's a bad situation to be in. So understanding what your expenses are and having a lot of confidence that you've got a plan and you can follow that plan. Okay, number 2 is kind of related, but just being realistic. If you are an American and you're retiring in the United States, which the vast majority of us watching this video are, our healthcare costs, even with Medicare, even once we get to Medicare age, which for most of us will be 65, even with that, healthcare is still expensive. In fact, Fidelity tells us that the average 65-year-old should budget $157,000 for the rest of our life in total after reaching age 65 for the cost of Medicare, the premiums, the supplements, as well as to cover the things that Medicare doesn't cover. So that is a lot of money. If you look at what the median net worth in the United States of a 55 to 64-year-old is, and this is net worth, so this is everything, including the value of the home. The median net worth is just $365,000. So if you carve out, a little over $150,000, that's almost half of what the entire net worth is of the average 50 to 64-year-old in the United States. So underestimating cost, and in particular underestimating healthcare cost, can be a very unpleasant surprise, unfortunately, later on. Okay, the next one is because expenses tend to be high, because there's uncertainty, right? How many of us would have predicted that we'd have 4 years of high inflation recently? That would have been hard to predict a decade ago. So because we have these expenses, because there's inflation, and inflation is a real thing, and we have to be able to beat inflation over time, because of that, sometimes early retirees are overly assertive in what their asset allocation is going to be. They may say, well, I'm fine as long as I leave my money in the stock market, 100% in the stock market. And this is not financial advice. I don't know your situation, but I do know, the one thing you have to be really careful of is to make sure that your asset allocation is something that you can withstand, not just in good times, that's easy when the market's up, but more importantly in bad times when the stock market goes down. And people are surprised to hear this, but top to bottom in 2007, 8, 9, the great financial crisis, from the top of the S&P 500, where it peaked out before the great financial crisis, to the low point, which turned out to be March 9th of 2009, top to bottom, it was almost a 60% drop, 60. So don't get too assertive with your asset allocation, because that can be a very, very scary thing to have to live through. I encourage it. This is not financial advice, and because of that, I encourage you to work with a financial advisor to help you just understand what the right asset allocation is for you. Okay, the next one I mentioned earlier about expenses. The flip side of that, the cousin to expenses, is returns on your portfolio. And people will say, well, in order to retire early, I only need a 12%, a 10% return on my investment account. Well, that might happen, but I'm not sure that you want to depend on that actually happening. Returns like that, yes, there have been periods of time where the stock market has returned that, but to get that type of return, you're likely looking at a portfolio that's close to 100% stocks. And as we talked earlier with asset allocation, you got to be really careful that you can withstand the negative that comes with that. The other thing that's really clear, really important is, and this is something that's hard for people until they experience it, and by then it's too late, and that is the pain of market down cycles, the pain of losses in the stock market increased dramatically for most of us once we're no longer putting new money into the stock market. So the pain of loss, even though you might have in the past been able to withstand some of those big market fluctuations, I caution you to be careful, because the pain of loss, the pain of when the market goes down, increases once we're no longer working. And for many people, it's not just marginally more painful. It's not just 10 or 20% more painful. It might be 2, 3, 4, 5 times more painful than it was when we were still working. So be really careful, because we don't want to blow out of our investments. We don't want to blow out of the stock market when it's at lows because of the pain, because of the emotional pain involved with losses. And if your asset allocation is not correct, the best time to reallocate and get that asset allocation correct, the best time to do that is when the market's at or near all-time highs. The worst time to do something like that is after the market's taken a 30, 40, 50% correction and say, ooh, this is not the right asset allocation for me. Well, then you're in a really tough spot. So I hope this video is helping you think about, should you adjust your asset allocation? And as I record this, the market's pretty close to all-time high. So if you're not at the right asset allocation, now might be a good time to think about doing it. Okay, the number five mistake that people make in early retirement is just having a general idea of a plan, of having not done a plan. And they feel pretty good about their plan. It might just be a mental plan, and they say, if I take the 4% rule, I should be okay. And, that's okay when you're just kind of thinking about retirement. But as you get more serious about retirement, I think you want to do a deeper dive into that. You want to look more closely. And you don't want to think you're okay. You want to know that you're going to be okay within as high of a level of certainty as you can. And there's really 2 ways to get that. One is to hire a professional, preferably somebody that's a fiduciary to you 100% of the time. And the second is to use some software tools that will help you get that level of clarity, help you get that level of certainty. And one tool that I like, this is not sponsored by this company, but I do have an affiliate link in the description below, a really robust tool to analyze your financial situation and to get that confidence, is Boldin, Boldin. If you decide to use it, it's very, in my opinion, very affordable software. You're going to be surprised at how reasonable it's. As I record this, it's $120 a year, so $10 a month. And if you use my link below, it won't cost you anything extra, and you'll be supporting the channel. And I want to leave you with a bonus, which these are some cautions about early retirement. But one of the things that's also a danger to all of us is giving up what I call the youth of our senior years unnecessarily, continuing to work past the point we want to and past the point that we need to. And that's why I made this video up here. Why retiring at 65 might be a big mistake. Thanks for watching this video, and I'll see you in the next one. Bye-bye.